Remember that trip you were planning? The one where you're finally going to visit that place you've always dreamed of. Picturing yourself strolling through those markets, all those amazing crafts and delicious food, and then, bam, you got to exchange your money. Suddenly, those prices don't look quite as good, right?
Yeah, exchange rates can definitely feel like a bit of a roller coaster sometimes.
Totally. And that's exactly why we're doing this deep dive. We're going to break down those mysterious forces behind those numbers that never seem to stay put. We'll be using this article, Factors That Influence Foreign Exchange Rates, to guide us.
Think of it as a little cheat sheet to understanding how the global economy ends up impacting what you're paying for things.
I like that. A cheat sheet. Okay, so let's start with the basics. We're talking about foreign exchange rates, which, if we're being honest, is just how much one country's money is worth compared to another, right?
Exactly. It's like the price tag you see on a currency.
Okay, so the article really leans into the whole supply and demand thing.
Mm-hmm.
They say that's really the big driver here. Like, imagine if it was Black Friday and there was that one super popular gadget. Everyone and their mother wants it, but there are only few to go around.
You'd have a massive frenzy with everyone trying to get their hands on it, prices going through the roof, high demand and low supply, classic economics.
And it's the same with currencies, right? Like, if everybody and their dog wants euros, but there's not a ton of them just floating around out there, their value is going to skyrocket.
Exactly. It's the same market forces at play.
So the article then breaks down these 5 big factors that really mess with exchange rates. I think we should try to unpack those, don't you?
Let's do it. Let's decode these big players.
Okay, so first up, inflation. That's a word we hear everywhere, but the article explains how it basically eats away at our money's value.
Yeah, you hit the nail on the head. High inflation just means you need more of your currency to buy the same amount of stuff. Imagine that loaf of bread you used to get for like $2 suddenly costing you $2.50.
It's like your money is constantly playing catch up with its own value.
It's like a never-ending game it can't win. And unfortunately, that makes holding that currency a lot less appealing, so it can lose value in the foreign exchange market.
So if a country is dealing with insane inflation, their money could take a real hit on the global stage.
That's right. Think about it. Let's say this country with out-of-control inflation makes electronics. Those electronics just got a lot more expensive to produce, right?
And if they're pricier to make, they're going to be more expensive to buy.
Exactly. And that impacts demand. People might start looking for cheaper alternatives, and suddenly that country's exports take a hit, which, you guessed it, can impact their currency's value.
So if a country's dealing with runaway inflation, their money's basically on a one-way trip to devaluationville. But hey, let's move on to the next culprit on our exchange rate hit list, interest rates. I'll admit, this one always makes my head spin a little.
Well, think of it this way. Imagine countries are throwing these massive savings account parties.
Okay, now you've got my attention.
And everyone wants to go to the party with the best returns, naturally.
Makes sense. So the countries with high interest rates are like the cool kids everyone wants to hang out with, attracting investors left and right.
You got it. Higher interest rates mean investors can earn more, so they're drawn to those currencies like moths to a flame. It's a global competition for who has the most attractive savings account.
Now that you mention it, haven't there been a bunch of interest rate hikes in the news lately?
Oh, absolutely. It's a direct response to that pesky inflation we were talking about. Central banks worldwide are raising interest rates to try and put a damper on things.
So they're trying to walk that tightrope between keeping inflation in check and making sure their currency doesn't completely tank on the global market. It's a delicate dance, for sure. Okay, so we've got inflation and interest rates doing their thing. What about deficits? Those have got to play a role, right?
Right again. Imagine a country's been on a bit of a spending spree, importing way more than they're exporting. Basically, they're shelling out more of their own money to buy foreign goods than they're making from selling their own stuff.
So they're in a trade deficit, which isn't exactly a recipe for a strong currency. Kind of like that friend who's always hitting you up for a loan but never seems to pay you back.
That's a perfect analogy. And to cover those debts, they need to buy more foreign currency, which drives up demand and can actually weaken their own currency even further.
It's like they're stuck in this loop of having to trade more and more of their own money just to stay afloat.
Yeah,
Makes you think twice about all those made-in labels, doesn't it?
it really does. Okay, up next on our list of exchange rate influencers, the article talks about how countries drowning in debt can really spook investors.
I can see why. Debt's not exactly a glowing endorsement for a healthy economy.
Exactly. Think about it. If you were lending money to a friend who's constantly in debt, you'd probably be a little hesitant to give them another loan, right?
Yeah, I'd be wondering when they'd ever pay me back.
And it's the same with countries. Investors get nervous when they see a lot of red ink because it screams financial risk. That lack of confidence can lead to a drop in demand for that country's currency.
It's like a giant game of trust fall, but with an entire country's economy on the line. All right, last but not least, we've got import-export balances. The article gave the example of India with its booming software and tea industries. So being a big-time exporter like India means you're raking in tons of foreign currency, which has got to be a good thing, right?
It's a fantastic thing. When a country's got a killer export game, it means they're bringing in more foreign currency, increasing the demand for their own currency and boosting its value.
It's like they've struck economic gold.
In a way, they have. They've tapped into a global demand, and it's paying off big time.
So it's not just about tea and software, right? Any country that figures out how to meet a global demand can see those positive effects on their currency.
Absolutely. Think about like smartphones. The whole world's hooked on them. Those countries producing them. Yeah, they're seeing a nice little bump in their currency's value thanks to that global demand.
It's like striking gold, but instead of digging in the ground, they're tapping into global desires. Okay, wow, we've covered a ton of ground here. Inflation, interest rates, deficits, debt, import-export balances. It's pretty amazing how interconnected all these factors are.
It really is. You tweak one thing and it can snowball into all these other changes.
Exactly. It's like a giant game of economic Jenga.
Mm.
But let's bring this back down to earth for a second. What does all this actually mean for our listeners?
Well, the cool thing is that understanding these factors can really come in handy, like planning a trip abroad. This knowledge can help you anticipate how exchange rates might affect your budget.
Right. Or maybe you're thinking about investing overseas. Knowing this stuff could help you spot an opportunity.
Exactly. It's all about connecting the dots between global events and your own financial decisions. Suddenly, you're not just reading headlines, you're understanding the forces behind them.
It's like having a superpower. You can decode the global economy and make it work for you.
In a nutshell, yeah.
So, as we wrap up our deep dive into the world of foreign exchange, remember this. The next time you check those exchange rates, think about those puppet masters behind the scenes, those 5 factors we talked about. That seemingly tiny shift in numbers. It could be driven by inflation woes in one country or an interest rate hike in another. And who knows, understanding those connections might just give you a leg up, whether you're planning a dream vacation, making an investment, or just trying to make sense of the financial news. It's a fascinating world out there, and now you've got the knowledge to navigate it like a pro. Until next time.